Okay, thank you everyone. Thanks for joining this panel. The next panel is going to be about fintech lenders disrupting the SME lending space. Let me just introduce myself. My name is Ido Vigdor. I'm a partner at Viola Credit. I'm part of the Viola Group. For those of you who don't know, Viola Credit is a multi-strategy credit fund that's also providing lending capital to fintech lenders, such as the ones that are sitting here. And I'm honored to have these panelists here with us today. So I want to start by a brief introduction. Why don't we start with a brief introduction on each and every one of you. Tell us a little bit about yourself and your company. Shai.
Hi, my name is Shai Feinberg. I'm one of the founders and VP Business Development on behalf. A little bit of background about myself. I actually started in the investing world for about 10-15 years, and then I crossed the Rubicon and I became a startupist. And there were times that I wanted to look back, but I didn't. And we started Behalf 6 years ago, and I can show you the background how we started.
Hi, my name's Anil Stocker, and I founded a company called Market Invoice. We're based in London, first time in Tel Aviv, so enjoying it so far. We were one of the first marketplace lenders in the UK, focusing on helping businesses raise money through invoice finance. We built a couple of solutions in invoice finance, and we also now launched a business loan product, which we're looking to scale. We are approaching very soon, next week, the 2 billion mark of gross invoices bought on our platform, which is a big milestone for us as a company. And about 750 million of that has come in the last 12 months. So it's been exciting. We're a team of about 85 people and looking to grow our product set and have more different types of funders finance the marketplace.
Hi everyone, Noam, VP Risk in Fundbox. Fundbox is a fintech company that was established 5 years ago by Israeli founders. It's working currently in the US market, where we leverage machine learning models to provide cash flow solutions for SMEs. We do that thanks to an awesome team that sits in 2 offices, one in Tel Aviv, one in San Francisco. And thanks to awesome team of investors, among them Jeff Bezos, Kostla, Spark Capital, and many others. I personally joined Fundbox 3 years ago after I held a few positions both in the high-tech world and the traditional lenders. Among others, I managed the credit risk modeling unit in Bank Hapoalim and the risk management department in Visa Card.
Good morning, everyone. I'm Nir, co-founder and CTO of Bluevine. Bluevine started its operation about 4 years ago. We're doing small business loans in the US, mainly online invoice factoring and a business line of credit. We deployed to date nearly $1 billion. We're really focused on the US market, and we have the R&D center here in Israel and the headquarters in San Francisco.
Great, thank you everyone. So it's really nice to see that we have 3 out of the 4 coming out of Israel, global fintech players in the space. So I want to set the stage a bit. So we're seeing tremendous growth in the volume of online lending. There's a lot of news and noise around online lending, and I want to go back a few years back. Obviously today, I think that the question of the entire industry is behind us. The industry is here to stay. I think the question today is how big will this industry be over time? But I want to hear from the personal side, maybe a few years back, what brought you to actually start and focus on small businesses back in 2010 or before that?
So sure. So one of the founders came to myself with the idea to provide working capital to small businesses, and I've got a good friend who actually is based in London, and he started a company called Wonga, which gave payday loans to consumers, and started long before. So he was really a close friend of mine, and I saw the growth in it, and I saw how technology can be applied into actually provide financing online. And when the idea came up with working capital, we prepared a presentation, went to Sequoia, and the rest was history. So I would like to say that it was like something that we really built and made, thought about, but it was a lot of serendipity involved, and it happened as many of these things happened.
And our story was actually myself and two founders. We'd spent some time in finance, and we wanted to build a business. We were interested in online lending. We were in London, where we saw companies like Wonga on the consumer side doing well. And our initial idea was actually more to start a more traditional fund, like almost like a venture fund, but we went and met 50 businesses, and they told us about their problem with the difficulty in getting bank finance, and how the products were not well suited to them, very slow and painful. So that's when we started to write the business plan to start Market Invoice. So it was really born out of the need of the customer.
Well, I wasn't around in the early days of Fundbox, but our CEO and founder, Eyal, likes to tell over and over the story how he observed his mother struggling to run her small business, and how hard it was for her to get a line of credit from her local bank. So we realized that there must be a way to provide a better access to funding for small businesses. And not only to do that, but also to do that in a way that will actually help small businesses reach their full potential. Currently, there are around 18 million small businesses in the US alone is being killed due to cash flow problems. They're struggling because regular traditional lenders is simply saturated. It's simply not profitable for them to underwrite small businesses. They use manual, traditional processes, which require from them a lot of resources and cost them a lot of money. And since the average loan size of a small business is pretty low, it's simply not profitable for them. So what they often do, they use personal scores such as FICO, which simply leaves a lot of portion of the SME landscape underserved, because the business can be great or with a lot of potential, but the owners all of the times have low personal FICO scores. So this is where we step.
Me and my partner is also called Eyal. We're looking to do something for small businesses in the US, because it's a well-known fact then and even today that this market is really underserved. I think it was mentioned in this stage earlier a couple of times. One of the things that we quickly came across is that there is a huge industry of invoice factoring. Tens of billions of dollars each year. It's actually an industry that grew during the 2008 crisis, and it's all offline, manual, very, very old industry, but very profitable. And we decided that we really want to innovate on this industry and create like a real online factoring service. And this is how we started the company.
Great. So I want to move a bit to talk about and look from the perspective of the small business owner. So I think over the years, and yeah, I'll start with you on that one. I think over the years, obviously the frictionless, the fast processing, the fast decision making has changed the dynamics and the expectations of small businesses. How do you see that? Maybe you can talk a bit about that. How do you see it changing, and how does Bluevine differentiate and help these small businesses?
Okay, so when we started the company, and invoice factoring is not your cheapest financial service. We were really under the assumption that most small businesses will be very sensitive for pricing, and we have obviously a couple of pricing options. But what we found out pretty quick is that small business owners, they really value speed. and we saw that they're much less sensitive for pricing, much more for, how soon can you make a decision, when can I get the money in my bank. A lot of them need to pay their employees, a lot of them need to buy inventory. So speed became very quickly, one of the key factors in that sense. Today, as we grow and we have also business line of credit and obviously many more customers, we see that it's not only the speed that they care about, but it's also do they get the right amount that they need, and also do they get it in the right structure, right? If they need like a business line of credit, do you offer that? If they have invoices, do you support that? If they need like 100,000 or $500,000 or even 5 million, can they get it from you, right? So, and we see that evolving, that the business owners really want a lender that they can grow with. They can give them the variety and they can support them as they grow their business.
Great. Shai, same question to you. You have a large repetitive customer base that you're treating. How do you see the servicing and the expectations to treat these customers?
So, small businesses, are run by consumers at the end of the day, people, and they act a lot in very much the same way. And consumers today remind me a lot of my kids, that they want things now and they want it quickly and easily. And you've got to cater for that. So you have to have a very, very simple flow that's very easy to use, that's is very, in terms of efficiency, it's very quick, the answers to get back. And those are the top of the priority in terms of what they need. Obviously you have to get the right line size and you have to get the right terms, otherwise they won't bite. But you have to, there's many offline solutions that are giving them the right line size and the right terms. So you've got to come in with how you differentiate, and that's more on the speed and the efficiency of getting it without regulation.
Anil, unlike the others, you're mainly a marketplace, and as a marketplace, not only the friction but also the time to provide the financing to the small business is an essential part. How did you overcome the fact that you are a marketplace to treat and the demand of these small businesses?
Yeah, being a marketplace obviously has some issues that you have to think through, as well as some advantages. So we're able to scale the funding lines pretty quickly by adding additional people to the marketplace without having to raise a balance sheet ourselves, which has allowed us to have different pools of risk and different risk return profiles to match different investors. But we started our platform mainly with high net worths putting money in. And they would look for a slightly higher yield, and so we're going after smaller businesses with a higher price point but easier product to use, as we've been discussing. That was popular, and now as we're offering bigger invoice finance facilities to bigger companies, we're going to banks, and banks are starting to put money onto the platform. So it's been tough sometimes to balance the liquidity required versus the demand. We always planning 2 steps ahead in terms of what's the funding that we need, what products are growing faster than others. But then there's also, as I said, great advantages of the speed, and we can match more funders in and grow that side quickly. So, but we're not wedded to one model. I think we want to bring capital that matches the underlying product. That doesn't always work the best with the marketplace, so we might become more like a hybrid funder. So we're quite open-minded. We're not like ideologically set on marketplace.
So I'd like to move on a bit to talk about the underwriting and the data. So one of the key advantages, I think, today of online lenders is the access to data and to machine learning and artificial intelligence and autonomous decision making. And I think that obviously traditional banks today they rely heavily on FICO. I know that FICO itself is not reliant on FICO. Maybe you can elaborate about how you see the underwriting processes within Fundbox, and how do you leverage data for the decision making?
Sure. So first of all, yes, in order to be able to assess the risk, to underwrite small businesses, and even very small businesses. We decided to take a bit of a unique approach. I can touch some of the principles that are in the basic of that approach. The first one, as you said, is the way we treat our data. So since day one, we invested a lot of time, effort, and a lot of money in our data, in our ability to build machine learning models that will be able to assess the risk of those SMEs as efficient, as accurate as possible. Those models are being run in a fully automated process. I think we are the only company in the industry that is underwriting SMEs in a fully automated process. We have 0 underwriters in the company, and still, due to those models, we're able to reach loss rates of low single digits and declining. The second element is, as you said, the no FICO element, this principle. Unlike all of the traditional lenders and most of the even alternative lenders, we decided not to use FICO. Instead, what we do, we use other data sources, business data sources, such as accounting software of the business, bank accounts, that if you know how to analyze well, obviously automatically, can provide a much more accurate risk assessment of the business itself, not of the loan. The third element that I want to touch is kind of a big one and is kind of unique to Fundbox. We like to call it internally the small business graph. You can think of it as something like a Facebook social graph, just that instead of human interactions, interaction between human beings, social interactions, we have business interactions between businesses. So up to date, I think we have monitored in our business graph over 60 million business transactions from over 10 million different businesses. So this data provides us a lot of deep insights regarding business interactions, cash flow, payment terms, business relationships, and these features are being fed into our risk and business models and improving them significantly.
Great. Nir, do you want to pick from there?
Yeah, so I don't want to say if we're the only company that does something or not, but we giving quite high credit lines. So for business line of credit, we give up to $250,000, and for interest factoring, we give up to $5 million. We target, pretty medium-sized businesses, and when you give such a high credit line, and you want to keep your losses very low, you better, do a proper underwriting. We use a couple of dozens of data sources that they have a large variety, starting from things that banks do have access to, like bank transactions, obviously, and credit reports, but also a lot of social information and other APIs that are available in the US. One of the things that I think US has a big advantage over other countries. I don't know the situation exactly in the UK, is that you have a lot of sources that you can get on small businesses. And for one example, you can in many cases read Yelp reviews on a business and see how the business is doing. I don't think that this is something that we will see banks using very soon. So the richness of the information really allows you to do much, I would say, more diverse and smart. Obviously, we're using a lot of AI and machine learning, and it has to be scalable because the amount of data is just like huge.
Great, thanks. Anil, open banking, PSD2, they're changing the landscape right in Europe. Maybe you can touch that a little bit about that and how this would change or help in the underwriting processes of market makers.
Yeah, absolutely. So touching on what's already been said, actually UK is probably the best place in terms of online information of small businesses. We have a central companies house where companies have to file every year statements, and if you're above a certain size, you have to file full statements, not abbreviated ones. So there's quite a lot of transparency there, plus all the other data sources that we've already spoken about. But one area where the banks have had a kind of walled garden has been bank account information. So currently, if you apply for a loan from an online lender, you, as a customer, you have to either upload like bank statements directly as a PDF or an XML file, or there are some like companies like Yodlee that do some sort of screen scraping. But if you allow that as a small business, you potentially put at risk your contractual arrangement with the bank, which means that if money gets lost, you're not entitled to compensation. So it's been a bit risky for people to use that. But PSD2, Payment Service Directive 2, and Open Banking, which launched in January, and there will be some teething issues, it's not kind of fully live yet, will enable mandates that banks have to provide API access to third parties for SME users to share their bank account information, which not only makes it easier for companies to get quotes, so they can press a button, sync their bank account, we can do a credit check on their bank statements and give them a quote like instantaneously. It also helps with switching and allows us better to automate more the underwriting process, because we've had manual underwriting or manual underwriters. We still have that component in certain of the transpositions of bank account information to our model. So it's really exciting. I think a lot of people are excited about it. The banks are not excited about it, so they drag they struggle a little bit due to their huge legacy systems to be ready. But they're coming under a lot of pressure from the government and the EU to make this work, and hopefully we're quite close to the head of open banking. Says the whole world is looking at this pilot to see whether they will do it elsewhere, like Singapore and US, and they're all looking to see how it goes.
Before we move on, one more question around the risk appetite of online lenders. So, if we're looking at approval rates with traditional lenders, obviously online lenders we're seeing in the public companies and also the private companies, the approval rates are higher. Does that necessarily mean that online lenders are taking additional risk, or the risk appetite is higher?
No, not at all. So as I said before, we just use different data sources. We have, I believe, better models, better ways to assess population that are simply underserved and can be underwritten by traditional lenders. If every lender is using the same data source, such as FICO in the US, what's happened is that eventually they're all going after the same customers. Our ability to assess businesses based on a variety of data sources give us the option to have decent approval rate and very low loss rate. Obviously, the bottom line is we have to be profitable, and our approval rates are pretty much the same as the traditional lenders. And obviously, we're there to make money, and loss rate is the big chunk of the cost. So the appetite is not higher, not at all.
So I'd like to move to the next topic that we want to touch, and that is, so we've touched on a few of the pillars of the online lending, but one of them is actually the cost structure. There's a completely different cost structure rather than traditional lenders, right? So the online lenders don't need to have the branches. The way that they're underwriting is less costly, etc. Using robotics for servicing, etc. But yet, bringing new customers is still a challenge, and it's always a challenge for the entire industry. And one of the ways that I know that a lot of the online lenders are using is channel partners. Shai, maybe you can elaborate on that, on how you see channel partners and the entire theme of acquisition costs.
So we work both with buyers and sellers, and this allows us to mitigate the cost of getting new customers. We've also got a strong relationship with MasterCard that allows us to pull in additional customers. So working together with aggregators aggregators of SMBs allow you to drop the costs considerably, and obviously there's a few of them that really stick out, and we try to work very closely with these type of players.
Yeah, Neil, can you continue from there?
Yes, we call it strategic partnerships. Channel partnerships is very important for us. as was mentioned, it's a lower cost of acquisition. We've done some work with the online accountancy platforms in the UK, such as Xero and QuickBooks. I think that started as like just listing in their app store, but now they're starting to promote us a little bit more from within the app, which is the first in the UK for this. We also launched some pilots with some banks, with one bank in particular who had quite a big customer base in the UK, but we're not offering any lending products, and so we did a kind of co-brand product where they will go and market it to their customers and come into our journey, our underwriting process, and then the bank will fund them on the back end. So that's an interesting pilot to see whether this kind of collaboration between a bank and a fintech can work. It's early days, but we'll see. But there's a lot more appetite now from some of the legacy financial institutions to partner up. And then, of course, there's other channel partners like accountancy firms who help businesses, or venture capital firms who help businesses grow, and we like to partner with them.
Great. And Nir, can you talk a little bit about the strategic partnerships that you have in bringing in new customers?
Sure. So in the US, we see, I would say, mainly three types of partners. One is obviously like what was just mentioned, a long tail of like a small accountant or a financial advisor that has like 10 or 20 clients, and all of a sudden they see that they need like some kind of funding, and they can refer them to a lender, or obviously to Bluevine if it fits. The other one are like maybe larger companies that provide services to small businesses, not necessarily lending, whether it's site building or payments or things like that. And then we can build, and we actually do build some kind of referral program with these kind of companies. And the third, which is something which is quite popular in the US, is like lending portals. So there's like Fundera that we work with, and QuickBooks Capital, which basically small business comes there, gives some information, the portal understand the business state and the exact needs, and then they refer them to Bluevine. We obviously have a couple of those partnerships. We find them very efficient and successful, and we just see that growing all the time because the demand is there, right? Like small businesses in the US all the time are looking for capital.
So let's talk a bit about regulation. At the beginning of the days and until today, we're seeing a lot of the regulators backing and assisting to online lenders to set an alternative to traditional banks. Yet there's a lot of still uncertainty in regulation. I'd like to hear how you see regulation today and going forward, both in the US and in the UK. Let's start with the US. Maybe Shai, you can start.
So up to now, many of the online lenders have been working in an environment called merchant cash advance, which has given a lot of flexibility to the online lenders, as opposed to how the banks work within the banking systems and the regulations around the banking systems. I know specifically around the States. I'll leave it for the rest of the panel to go into other areas, but around the States, the regulation is actually changing, and in 2018, towards the end of 2018, if you want to give a loan, you're going to have a banking license. In order, we've already got this umbrella banking license from another company which allows us to give loans. So on the one hand, we've had flexibility to grow up to now, and on the other hand, having the banking license coming into play means that it's going to be a little bit tougher, and there's more barriers to entry going into the market. The outlook just generally, though, is that Trump is very positive about going forward and helping lessen the regulatory environment for small businesses.
Anil, can you talk about regulation in the UK?
Yeah, the UK regulation has been very favourable to fintech companies and online lenders. The FCA, which is like the Financial Supervisory Board, has from the beginning encouraged innovation. They did not require any FCA regulation when we started, and now there's a very light touch regime. So that's fostered. That's, I guess, one of the reasons why there's so many lending companies, online lending companies in London, based in London. And now with open banking again, they're helping the sector to grow. So I think that it's been very benign. It's been very forward-looking. I think London maybe is rivaled by Singapore in terms of its encouraging environment for fintechs. And I think the last government, this government, everyone wants Britain to be like the center of fintech. So they don't want to do anything that will quash the market.
Nir, do you want to elaborate a little bit about the regulation, how Bluevine, I know that Bluevine is actually working closely with the regulator in the US as well.
Yeah, well, so when we started with invoice factoring, there was a question: is it actually a loan? Do you need a lender license, or is it just like a true purchase of an invoice? We know that a lot of manual factors don't really work under any regulation, but we went for the safer side. We got a California lender license, and I think that one of the challenges in the US is the different states. What they respect and what they don't respect from other states, and their relationship with the federal government. We just recently also for the business line of credit started to work with Celtic Bank, which allows us actually to deploy business line of credit in all of the US. There's a lot of regulation going in the US. Again, it's a little bit tricky. Like even a bank charter in the US, there's different tiers, depends of how much capital you have and what you do exactly, and whether you can just lend or you also want to have like a deposit and things like that. So we are following that. We work with a lot of lawyers in the US, I must say, and it keeps changing. And I think that all in all, like the trend and the direction is good. It's really like you see a lot of things that really want to enable both the fintech industry and definitely the small businesses to work in a more efficient way under the right regulation. And it's not there yet, but it's definitely going into the right direction.
So I think we're close to being over time, but just before we finish, give me your outlook 3 years forward on how the industry would look like, and where would you be focusing with your companies? Shai, why don't you start?
So the growth up to now, and we believe is going to continue, is that the small businesses are going to pay already over 50% of the economy in the States they account for, and it's going to continue. This direction is going to continue. So we're going to continue giving access and easy access of capital to these small businesses, which will allow them to continue their growth. And it's just tying it in the right, seamless, timely way, which is the challenge. And that's what we, the whole time, working very closely with our product team to make this work.
Yes, I think it's really interesting because when I started the company, Market Invoice, we were very much like one product, which was an add-on facility to like core banking. So a business would have a core bank, like HSBC, and then if they couldn't get the funding they would want, they would come to Market Invoice or elsewhere to find it. But what I'm seeing now is like a shift to now the business is saying, well, if I can get a great experience in Market Invoice and lending, why can't Market Invoice do more for me? Why can't they actually build products around my needs? So our thinking is kind of shifting to actually, hey, we could be the primary financial partner for the underlying business that we like to support. And that is quite it sounds a very sort of small shift, but actually it's a big shift in the way that you think, because all of a sudden you actually start to think, hey, can we not provide the core banking functionalities for these businesses? And that's a much bigger vision, I think, than when we started. And it's something that is just becoming possible now in the UK for us. I mean, you don't even need to get a banking license to offer all that core functionality. So I think we are thinking quite closely about this versus just having monoline lending products.
Yes, so in Fundbox we are looking for other ways to improve the way we can provide stronger, better financial power for businesses. There are a lot of different products and initiatives we're working on. Some of them are just to improve the access and the way the users can use our product today. So for example, where we just developed and implemented a tool that can be integrated in every software, in every service software in just 3 lines of code. And so user customers can access the product directly from the working app exactly whenever they need us. Another thing we're trying to focus now is the B2B payment network. This is a huge market, around $4.5 trillion market. We are going to focus in the near future. We're going to launch in the next few weeks a new product, a new tool for this market that will provide a much needed infrastructure for this industry, for this market, as well as a credit solution for the buyer side as well. So far, we focused a lot on the seller side. We're going to focus also on the buyer side and provide solution for them as well. In the longer term, we also want to try and provide, to leverage our data and our machine learning capabilities in order to help our customers just make better decision making. We have a lot of data and we can leverage this data in order to help them. With tools such as Virtual CFO or Advisor, we believe we can add to them a lot of value.
So I think that in the short term of the next year or two, we're going to see small businesses' life continue to improve and become better. They'll have online banking, they have online lending, they have online payments, and they have it on their browser and they have it on their app. And these services, are better user experience, better fit their needs and things like that. But I think that as a longer wave, small business doesn't really want to have like 6 different apps or 6 different tabs open on his browser. Just like that's my bank and that's my billing provider and that's my lending provider and that's this and that's that. And I think that we're going to start to see more consolidation around that. Again, I don't know if you'll get to a situation when you have one perfect partner that can give you everything, but maybe. But I think that it's definitely going to be in that direction.
Okay, well, I want to thank everyone in this audience and the panelists. Thanks for your time. I think we're out of time. Thank you.